continues to go, and there's a lot of reasons that could happen, and the reason why it is happening. But we did get a retail sales report, and I don't want to get too wonky, Brian, but there does show the health of the economy and the health of the consumer.
That's right. This past week, we got the retail sales numbers for the month of September. So it's just 1 month, but it was surprisingly strong. September was one of those months, if you remember, there were a couple hurricanes. There were also some work interruptions. You have the Boeing plant shutting down, the strike at AT&T. And so economists were penciling in that we were going to see some weakness. But the American economy, specifically the American consumer, continues to do pretty darn well. And so I think what really happened there, it just caught people off guard, that surprising strength. And as a result, the market had to reprice, what does the future look like? Are we going to have this soft landing where you get decent growth, inflation coming lower? And then also, does it mean that the Fed doesn't necessarily need to aggressively cut rates in order to stave off a recession? Are they in the position where they can cut as opposed to they need to cut?
And you think about what's happening there with the market, and they're trying to price in what the Fed is going to do, and obviously that guessing game has not really worked well over the last year and a half. And again, that potential rate cut is after the election, so there's a bit of a mojo in the market happening right now. So we are just assuming that the betting markets are correct and that we're going to see a 25 basis point cut in November and perhaps December, because the Fed has been pretty good about indicating what they're going to do. So you think about, more importantly, what that looks like from 30,000 feet for the consumer, right? If interest rates are coming back down, savers are not going to earn as much, but interest rates on things like mortgages will come down.
Yes, and if you have seen the 30-year fixed rate mortgage, the national average, that has been on a roller coaster ride. It was probably around 6.5% back in April. Then it went up. It went back down to about 6.5%. And for a little bit, it was looking like it was going to get to 6, maybe break into the 5s. But now it has bounced back up to closer to 7. So there's been, I think, some people feeling like almost the rug has been pulled out from underneath them, with the Fed deciding to take a slower pace of cuts and some of the economic strength. This massive opportunity to refinance higher cost debt into lower cost debt is going to have to be maybe a 2025 story as opposed to something that you have to pounce on today.
Then let's flip stories here a little bit and talk about what's happening in Europe. They are certainly slowing down, and they came out and they did what the Fed is talking about by cutting rates.
They did, yes. This is the second meeting in a row in which the European Central Bank cut rates by 0.25 percentage points. The last time they went 2 meetings in a row cutting was back in 2011. And so if you remember back then, that was in the United States, we had the debt ceiling standoff. Over in Europe, you had Grexit entering the vocabulary as far as everybody concerned about the Greek debt crisis. And so back then, they did cut rather aggressively. Now they're also doing it in a rather methodical but steady way, mainly because inflation, it has come down to below their target, 1.7% as opposed to 2%. But the problem is growth is pretty slow. When I look at the German economy, for example, they did rebound from that COVID downturn, but besides the rebound, they haven't grown much from that point forward. And so they have a lot of challenges over there in Europe to deal with. And so their central bank is in a position where they feel like they need to actually pick up the pace a little bit here with those rate cuts.
And speaking of picking up the pace and going the rest of the trip around the world, you've got China and their stimulus. They're kind of in a waiting game, but we saw a GDP report which was interesting, a little higher than I thought it was going to be. But you see where the Chinese equities are retreated because of that information.
That's right. Yeah, China, they have really been languishing. They're targeting 5% growth for the entire year. That might sound like a lot because, here we're used to 2 to 3%. But over there, they need that faster growth in order to maintain social stability, also to really get people moving from the more rural areas to the urban areas. So there's still this mass migration that's taking place. So they need that faster growth, and they're falling a little short of that. The GDP number was better than a lot of people were expecting. It was about 4.6% year over year. People were looking for something a little slower, but they have come out and said, you know what? We need to support the property sector. We need to support local governments as far as the amount of debt that they have. And the governor of the People's Bank of China came out and said, we also need to support the stock market. So it's almost like you have the national team coming out there anytime that there's a big dip for them to step in and buy it.